Hello everybody, this is Ilyas Pivak, currency strategist with Daily FX, and we'll be doing our weekly outlook on the long-term trend for the US dollar. Before we get started, if everybody can please type into the chat box, let me know if you can hear me, let me know if the video is coming through okay for everybody, and we will get started. Alrighty, looks like we are in good shape. So I see a couple questions here already. I will get to them. Certainly feel free to type in more. I want to first, before we begin to jump into your questions, take a look at what's going on here with the trend and see how that is likely to evolve in the days ahead. I have on the screen there a daily chart of the FXCM Dow Jones US Dollar Index, which we're using as a sort of general directional benchmark. We're not looking at trading that actual index, that actual asset. We're really looking at it as just the average gauge of the US dollar's direction. So really just a proxy. And as you can see here, as a proxy of US dollar movement, what it points to at this point is indecision. So we continue to see here a period of consolidation where we're not really finding that the dollar is essentially showing a lot of directional conviction. And if we take a look at the longer term view here, this is the weekly chart that we've been looking at. Those of you that'll remember where we got in here, we got in right as we took out this upper boundary of this consolidation pattern here, essentially suggesting that the up move that was this rally was resuming after this correction. And so what we're looking at is essentially the continuity of dollar strength, and you'll notice that we continue to hold above that trend support. So this rising trajectory, the latest leg of it that started in September of 2012, that actually appears to be holding thus far, and the dollar seemingly attempting to figure out what it's going to do now at this level, essentially attempting to find direction. Now let's take a quick look at how our basket is doing. We of course are trading the long-term evolution of this trend via a currency basket, where we've taken average exposure in the US dollar against four of its major counterparts: the yen, sterling, Aussie, and euro. You'll notice the picture is very similar to what we've seen over the past several weeks, which is the Aussie and the yen components of this are actually performing rather well, whereas the euro and the sterling components are hurting the situation, and really the sterling component in particular is starting is continuing really to be a hurdle. So let's take a look here first and foremost at what's been going on with sterling. Here's a daily chart of sterling, and you'll see here, we'll zoom out here just a bit, that essentially what we're looking at is the possibility that a double top is taking shape somewhere around here from a purely technical perspective. And I'll show you guys what I mean here with a little bit more of an involved chart. This is dollar sterling here, and you'll see that there appears to be a bearish engulfing candlestick pattern at this former top that's suggesting that we might move lower. And from a fundamental perspective, that seems to make sense. Now, we've talked about this before to some extent, but just to review sort of what the logic is here, there has been a notable change in the Bank of England's guidance since we saw the release of that quarterly inflation report in the middle of last month. Now, something very telling here. The inflation report was actually released on February the 12th. Now, since February the 12th, we've noticed something quite stirring. If we look at the yield on the benchmark UK 10-year bond, that yield rather conspicuously topped out after something of a bounce on February the 12th. So it hit a multi-week high. It had actually started to recover on February 3rd, and on the 12th hit the highest level that that it had seen for essentially about a month and a half. And since then, since hitting that level on the 12th, it has meaningfully moved lower, and is now hovering just above some significant lows. In fact, back in the final days of February, we actually hit the lowest on the 10-year yield since back in sort of early days of November of last year. So a significant decline. Now, sterling hasn't rallied in the face of this, but it likewise hasn't sold off. So what we see here is that monetary policy expectations have likely deteriorated, but sterling has not reflected this. Now, one naturally wonders why that might be. And looking at, again, the trend in the US dollar, one begins to sort of understand. Now, if we have a situation where the monetary policy outlook for the UK is deteriorating, but sterling isn't falling, the natural sort of way to think about this is to say, well, if sterling is not the culprit, who is? And again, here's a daily chart of the US dollar index. Notice this is again that same area, the 12th, the 13th of February, right here. So since about here, we've been in a consolidation range on the dollar, and sure enough, since again this same area, we've been in a consolidation range on sterling. Notice this high is the 17th, and on the dollar index, this spike low is the 17th. So what we're seeing here in sterling is essentially a reflection of the indecision surrounding the outlook for the US dollar rather than anything pound related. Indeed, if we clear up the uncertainty surrounding the outlook for the US dollar, one would reckon that the deterioration in bond yields in the UK suggests that sterling is now expensive relative to what monetary policy expectations justify and should decline. Now, what is this lack of clarity around the outlook for the US dollar? We've talked for a couple weeks now about the disconnect between US economic data and the Fed's commitment to continue to taper its quantitative easing effort. And the question has been consistently, which side gives? Is it the Fed that's wrong, and the economy is much softer than the Fed expects, and it should pause stimulus reduction? Or is it the data that is a transitory slowdown, and the Fed is right at looking at the medium term and right to continue to pull back on stimulus? Much of this is going to be decided this week, because what we are beginning to get here is the big data releases for February. And essentially what these numbers are going to do is set the tone for how investors are going to think about this slowdown's continuity. Is it something that is getting markedly better after lasting through December and January, or is it something that is lingering? Now, the ISM manufacturing number, which was the first sort of big piece of data to take note of this week, that came out better than expected, but the service sector ISM, of course, undershot, as did the ADP employment number. On the other hand, the Fed's own Beige Book survey was relatively upbeat, and continued rhetoric from policy officials, most recently the Atlanta Fed Governor Fisher, again sounding off on the need to reduce stimulus faster, not slower. And to a large extent, the make or break moment here will be arguably Friday's non-farm payrolls number, in the sense that if that number really does show improvement as expectations suggest, we should be seeing a bit of a closing of this disparity between what the Fed is seeing and what the markets are seeing. Now, what's interesting here is over about the past 1.5 to 2 years or so, the speed with which markets have moved to price in a slowdown in U.S. economic data has been, give or take, 2 months. So once data begins to turn soft and begins to undershoot expectations, it's taken economists, on average, about 2 months to scale down forecasts in line with soft performance. And what often happens is economists overshoot, and then data begins to outperform expectations, and you start to get a positive vibe, if you will. So, looking at this most recent deterioration, and assuming, of course, that this pattern holds, which is, of course, by no means guaranteed, and a big if at this point, but assuming that this pattern holds, we should be getting close to a place where forecasts have been adjusted, or at least almost adjusted. And so we should be running out of opportunities to meaningfully underperform on economic data, not necessarily because the data is getting better, but because expectations come down to match what's going on. But of course, from the market's perspective, if the data is coming out in line with expectations, as it is likely to start to do relatively soon, or so it seems, then you don't have much of an impetus for movement. The impetus for movement comes essentially from the disconnect between reality and expectations, and the need then to reevaluate your positions and essentially rebalance your portfolio. That's what sort of creates volatility. So if indeed non-farm payrolls later this week gives us a number at 150K, even though that will be in line with expectations, the dynamic since mid-January has been to underperform. And if you begin to see things settle, and you begin to see expectations firming, or seeing numbers firming relative to expectations, even if they come in exactly in line, or close to in line, that marks a break in the status quo. And that may be something that goes a long way toward shrinking this gap between Fed policy and economic data in the minds of investors. And if that occurs, then this confusion over the direction of the US dollar gets resolved. Because then there is no conflict, or at least the conflict is not as potent between what the Fed is doing and what the economy is showing. Because essentially what this standstill represents is investors' lack of confidence in the Fed's commitment to continue to taper. The markets are essentially holding out for the possibility that data will continue to disappoint, that the soft patch in the U.S. recovery is much longer than what the Fed expects, and that they will invariably be forced to change course, or at least to alter it. So far, the Fed has been adamant in not doing that. So if the Fed is proven correct, or if economic news flow begins to improve to suggest that indeed this was a temporary glitch, and that now that we've passed it, the larger picture remains in play, UK fundamental factors are certainly not going to hold this back. We already see that they're deteriorating. But the US dollar factors of the equation should come in line. Something very similar is happening with the euro. So here's the euro. And you can see that we've been edging higher, but we're again stuck at this triple top resistance right below the 138 level. And here too, the question is, well, where's the conviction? And here too, I would argue the question is that of policy uncertainty. Now, in the case of the ECB, the situation is a little bit more involved, in the sense that there is policy uncertainty here, not only in what the Fed is doing, so the dollar side of the equation, but also in what the ECB is doing. And that uncertainty essentially stems from their own disconnect, in this case between relatively strong readings for economic growth, which we again saw in the latest revisions for PMI numbers just over the past 24 hours, and continued disinflation. In fact, as I just wrote yesterday in my European market outlook, we're looking at benchmark CPI hovering near the lowest levels since late 2009. But even more sort of discouragingly, inflation expectations are near two-year lows. And it's those expectations that are the really scary component here. Generally speaking, the deflationary trap that captures economies begins not with realized inflation, but with expected inflation. Because what happens, the way that deflation sort of invariably materializes, is far sort of sooner than actual price declines. Because what happens is people begin to expect that prices will fall, essentially expect that goods will be cheaper tomorrow than they are at the current time, and delay purchases, delay investments. And what that does is it bears down on economic activity and self-actualizes further declines in prices and invariably deflation. Now, what the slide in inflation expectations suggests is that the markets are beginning to price for this possibility. Indeed, if we're sitting near a two-year low on inflation expectations, they've been working their way at baking this into the market for quite some time. And the sort of immediate question is, well, why hasn't the ECB done something about this? At what point will the ECB actually ease? Now, I am of the view that we are not going to get any further stimulus at this week's rate decision. And the consensus seems to be that. So if we look at a survey of economists conducted by Bloomberg, only 14 out of 54 expect any kind of rate cut. And as far as the markets are concerned, the probability of further easing is being baked in at just 2%. So we're talking about very, very low expected chance of a cut. And I tend to agree, because I think what the ECB is doing here is it's essentially waiting to get the asset quality review that it's doing complete before it does stimulus, because it faces in the markets a very clear disparity. The cost of funding in terms of euros is very cheap. In fact, it's actually cheaper in the interbank market than it is from the ECB. The ECB's baseline rate is actually higher than market lending rates. Now, that meant that the last rate cut they did attempt late last year was essentially a moot action, and it would make another rate cut here a moot action just as well. But what that speaks to is that if prices are falling, and they are, and if inflation expectations are falling, and they are, and borrowing costs in the interbank market are extremely low, and they are as well, something isn't happening in the middle there to transmit those cheap borrowing costs into more borrowing into inflation. For whatever reason, the ECB has successfully eased credit conditions in the interbank, but that is not translating into the real economy. Lending to SMEs, small and medium-sized enterprises, remains incredibly anemic. Excess liquidity worryingly low. But the cost of borrowing very, very cheap. So something is off there. Something is not lining up. For whatever reason, policy transmission isn't working. And so not surprisingly, the ECB is conducting this asset quality review basically to see why is it that the banks aren't passing on these cheap lending conditions. Why is it that stimulus isn't working? Because to continue to do stimulus that's not working wouldn't really be a very good thing for the ECB, both in terms of credibility and, of course, in terms of results as well. So what the ECB is probably doing here, at least in my mind, is they want to investigate where the disconnect is and either craft a stimulus effort around that disconnect that circumvents it, or fix the disconnect and then ease. And so I don't think they're going to move on essentially expanding stimulus until that asset quality review is done and the work of identifying that gap in policy transmission is complete. However, I don't see that this is likely to really boost the euro in a significant way, considering that, once again, the consensus in the market strongly opposes a change at this meeting. And so, if the markets get exactly what they were bargaining for, there's really no reason for us to expect volatility. The risk, of course, is that the ECB does put forward some kind of easing effort, which, of course, would aid our cause. But assuming that essentially status quo holds, I wouldn't expect the euro to really gain much strength there. Which again sort of takes us back to looking at the Friday NFP number and the dollar side of this equation. And judging from everything that Fed officials have told us, there is not even an inkling of hesitation here from the Fed on essentially the likelihood that the tapering effort is going to continue. And with that in mind, it seems essentially a matter of time for data to sort of either come in line with the Fed's forecast or really veer south and change what the Fed is doing. And until we get clarity one way or another, the baseline view that the Fed is going to continue to taper really remains. And that baseline view is essentially dollar supportive. And so as we continue to stall at these familiar levels, the sense is that we have indecision, but the bigger picture remains that the Fed is looking to continue to remove stimulus, while the ECB clearly is going the opposite direction. Indeed, even if the ECB does not ease and just stays put, that already in and of itself narrows the policy gap. Because as I've mentioned before, in a race where one person is crawling and the other is standing still, the one that's crawling wins. Now, to quickly check in on what's going on with the Aussie and the yen before we take your questions. Here is dollar yen. It seems to be likewise in consolidation mode here underneath the 103 figure. We're starting to, it looks like, build cautiously higher again after that bout of risk aversion. Not surprisingly, this is still a well-performing part of our portfolio because not only has risk sentiment been relatively supportive, but Fed officials, as I mentioned earlier, have been continuing to sort of batter this idea that the Fed isn't going anywhere, that essentially the taper continues. Now, similarly, let's take a look at the Aussie. Here's a chart of Aussie dollar, and we'll make this one a daily as well. Again, notice consolidation. We have this top here around 90.85. We have this range bottom down here around 88.90. Call it the 89 figure, give or take. And what we have is continued consolidation. And on this front, it seems not at all unclear what's going on, particularly after this week's RBA policy announcement, where we very, very clearly saw that the RBA is intending to stay essentially on hold for a period roughly of at least a year or two. At least so seems to suggest their inflation forecast. And so with that in mind, the moving component here is again the Fed and the lack of clarity. Similarly, just to take a quick glance back at dollar yen in the same context, again, we know what the BOJ is doing. They have been unambiguous. In fact, we wouldn't really expect to see anything new one way or another from the BOJ until at least the second half of the year, after there's been some time to evaluate the impact of that sales tax increase that's going into effect next month. And from there, we'll be able to see if they're going to expand stimulus or not. But in the meantime, policy standstill in Japan. And the Fed, the sort of question in this equation. Let's go ahead and take your questions. So we'll start from Richard over in Kent, who's asking, why is there no element of the BRIC currencies in the FXCM dollar index? Fantastic question, and the reason is because the volumes done in the BRIC currencies against the US dollar in the market are essentially insignificant. To get a really representative dollar index, adding the BRIC currencies would effectively do nothing. And I want to point your attention to the latest survey of foreign exchange volumes and market dynamics from the Bank of International Settlements. I'll give you guys a link for that. Here it is. This was actually just updated in 2013. And I'll show you guys, if I can pull it up here. It's a huge PDF. But hopefully I can pull up a summary here. And we can take a quick glance and see sort of how much volume we're talking about Bear with me for just a moment. Here we go. So you'll notice here, this is a table that basically tracks the share of particular currencies in terms of market volume. Here's 2013. So euro dollar accounts for about 24%, dollar yen 18.3%, sterling dollar 8.8%, Aussie dollar 6.8%. You'll notice those four top currencies are the currencies in the basket. You'll also notice that if we add those things together, we come up with 58% of all dollar or counter dollar trading volume. So you have really the representative basket here. Now, the closest brick currency is dollar yuan, which, as you can see here, accounts for only 2.1% of this volume. Dollar ruble, 1.5%. Dollar real, less than 1%. Dollar rupee, less than 1%. Right? So we're talking about very nominal additions to this basket. They really would make virtually no difference. Right? So we're talking about a couple percent in terms of volume and in terms of turnover relative to 58. So that's essentially why they're not in the basket. So if we do this sort of quickly, that's 2.1, 1.5, so call that 3.6. So roughly, let's say, about 5-6%. 6 if I'm being generous. Right? So compare that with 58%. And that is essentially why they're not there. Richard is also asking, why in the index is no attempt made to weigh it in accordance with FX volumes? We didn't weigh it because we actually found that a equal weighted basket is a little bit more representative because these weights oscillate over time. If you look at, for example, the DXY, which is the ICE dollar index, it's so heavily skewed toward the euro that you might as well trade euro dollar. It really is, there's really no major difference. Mostly because that ICE index was a much wider basket based on all of the legacy European currencies, which of course no longer exist and which are all a part of the euro now. But keep in mind, when you're trading one of these baskets, you're not trading the index. You're not trading our dollar index. You're trading a basket of currencies. And the weights within your basket will change over time. This is why the index and the basket are not the same asset, which you'll hear me write in articles and say all the time. Because once you put on a trade, the relative value of the dollar begins to change against the four currencies over time. And so the basket that I put on back when we put this on and the basket that somebody else would put on right now although the overall level of the dollar index is comparable, would be a very different thing because values have moved, which you can see in our P&L here. So don't confuse the index and the basket. They're not the same thing. Deborah is asking, in the past 72 hours, we have had a slew of favorable Australian data, which in my opinion is suffice to turn the bearish trend as interest rate outlooks no doubt must be revisited. What is your input? I don't think they ought to be revisited at all because the RBA has told us not to revisit them. And when the central bank sort of explicitly says, this is what we're looking to do, I really don't see a reason to second guess them. Here is the monetary policy statement from the RBA. There's a link. That's from earlier this week. And we'll put it up on the screen here. What I'm concerned with in this statement is this sentence. First and foremost, that says inflation is expected to be consistent with the 2 to 3% target over the next 2 years. And then this paragraph that says, in the board's judgment, monetary policy is appropriately configured to foster sustainable growth in demand and inflation outcomes consistent with the target. On present indications, the most prudent course is likely to be a period of stability in interest rates. That generally says, in my mind, that over the next 1 to 2 years, again, being generous, we're not going to get any meaningful changes in RBA monetary policy. That's what we're being told here, that inflation stays on target and that a period of stability, presumably while it stays on target, is warranted. And indeed, if we take a look at policy expectations that are being priced into the markets, we're not looking for any changes in RBA policy steps over the next 12 months. So as it stands today, the market is not expecting any rate hikes until March of 2015 at the absolute earliest. So I really see no reason to revisit it if indeed the central bank itself has said we're not doing it. Let's see. One guest is saying, I am holding a euro-dollar long-term position for a retest of the all-time high of 160. Do you think I'm insane? No, I don't think that you're insane. I think we just disagree on where the euro is going. Now, there are certainly quite a few people that are bullish on the euro. In fact, as of last year, I was bullish on the euro myself. At the beginning of, in a medium-term sense, and I want to stress that because from a multi-year perspective, I've been basically bullish the euro since, or bearish the euro since before it topped above 160. But as a structural sort of multi-year bias. But last year, actually, my colleague John and I wrote an outlook for the euro at the beginning of the year and laid out both the fundamental and the technical reasons for why the euro ought to have rallied in 2013, and that's essentially what happened. So, no, I don't think you're insane at all. I think there are compelling reasons for essentially expecting euro strength, not the least of which is the continued reduction in the ECB's balance sheet. But I don't think that that's what matters. I think that what matters much, much more is this threat of disinflation becoming deflation, and the threat that the ECB will have no choice but to ease further. Let's see. Follow up from Deborah. Excellent point. Saying, but with very good data, a rate cut becomes increasingly unlikely. To be sure, that's true. However, there is no reason for that to impact the markets if they were not expecting a rate cut. Right? Exchange rates move when people's expectations don't match reality, right? When reality turns out different than what people expect, they naturally have to adjust their positions to reflect the new reality, or what in their mind is the new reality. So the question is, why ought the Aussie rise on diminishing rate cut expectations if nobody's expecting a cut? In my mind, it shouldn't. And in reality, it hasn't. As you can see on the chart here, the trend has been overwhelmingly pointing down. And I think more of the same is likely in the cards here. Now, if we look at how long it's been since the markets have really been looking for anything but standstill on the Australian monetary policy front, the last time that we had legitimate expectations for a cut was back in sort of early August of last year. So around early August of last year, we were still looking for another cut. Since then, those expectations have been unwound, but we haven't seen meaningful expectations of a hike really emerge either. The last time we were anywhere near expecting a hike at some point, or essentially a turn in the monetary policy cycle, was in early October. Actually, no, I'm sorry, early November of last year. So for basically the last 4 months, people have been looking for standstill. 4 months is plenty of time to price in standstill in order for news flow that reinforces said standstill to not really be market moving. You'll recall the Aussie didn't really have very much upside after that very strong GDP number. It popped and then came right back down. And I think that's exactly why. Gal is asking, how is the fate of the dollar basket affected by stock markets? Excellent question. If we recall, the situation, for example, currently in the Ukraine, has sparked tremendous risk aversion. You'll notice it has not really been a major boost for the US dollar. It has certainly helped the yen. It has certainly helped the franc to an extent. But, and this is really it right here. But what we have here is essentially what amounts to a degree of intensity in risk aversion, sort of relative to previous instances. Now, the dollar, I would expect to really begin to take on a safe haven role if what we saw was a dramatic unwinding of risk sentiment. So if the situation in the Ukraine, let's say, led to open war, if for whatever reason there was a major disruption in the markets surrounding this, like, for example, if Russia turned off the pipelines that send natural gas and oil into Western Europe in retaliation for a sanctions regime, or vice versa, that could absolutely see the dollar rise in an aggressive way. But the level of intensity has just not been there. It's not been that aggressive. And so at this point, I don't think that there is really a major safe haven story to tell here. On the other hand, there is something of a positive story between stocks and the dollar, but what you have again is ambiguity. Now, most recently, if we take a look at the correlation between the US dollar and the S&P, which is essentially our benchmark gauge of risk sentiment, we're once again seeing a strong inverse correlation. And I think what that reflects is exactly the same thing that is reflected in this stance still that we're seeing in sterling here. It's the same thing that we saw in the dollar index. It is the disconnect between what the Fed is doing and what the economy is showing. And I think it reflects this idea that the Fed will be proven wrong and that stimulus will last longer because the data continues to disappoint. And that eventually the Fed will be forced to back away from this commitment to tapering. And that's really why we see stocks continue to push higher, whereas the dollar is clearly finding it hard to find a lifeline here. In a big way, the NFP number that we have coming up in just a couple days here can resolve this conflict, or at least temporarily resolve it by giving the markets a directional bias. It can either confirm what people seem to be holding out for and send the dollar dramatically lower, or it can go the other way and actually suggest that the Fed is in fact right, that they're not going to continue to reduce stimulus, in which case stocks would likely decline while the dollar would move higher. And so at the end of the day, I think, again, that relationship as well takes us back to NFP and takes us back to essentially Fed policy speculation. All right, with that, we'll call it a day. I want to remind everybody that if you have any follow-up questions, you can always feel free to ask them via Twitter at Ilya Spivak. If you would like to sign up for my email distribution list to receive my articles directly, that's easy enough. You can do that right here. And I will be back tomorrow for our weekly trading Q&A. at this same time, 1:30 GMT, only in Daily FX Plus. Thank you, everybody, for joining me, and I will speak to you guys then. Good luck out there. Take care.